Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat with our guest today, a guest who oversees nearly 35,000 crores worth of equity AUM and therefore has a worldview which very few people might have on the equity side. Let's bring up the case for a chat. We try and, of course, ask him about how the mood on equities as we inch closer to the rate cut cycle, if you will, and whether earnings can sustain the valuation premium. Will autofocus remain in FY25, or will we see that high decibel sector come off the wheels a little bit? And will global facing sectors like metals, like IT, see further pain, or could the scenes improve post the Fed rate cut? Sumit Jain, Deputy CIO, ASK Investment Managers, with us in the show. Sumit, great having you. Thanks for taking the time out. I hope all is well.
Very much. Thank you, Neeraj, for having me here.
Yeah, no, pleasure is entirely ours. So Sumit, as we inch closer to a potential Fed rate cut cycle, and presumably other central banks follow suit, I was looking at the markets since the COVID lows. The biggest driver, unequivocally, independent of valuations or markets, has been the central bank.
Correct.
Would this time be different, or do you reckon that despite the higher valuations, and rate easing cycle can spur equities further?
See, at the end of the day, equities are function of growth. They are also function of what is the volatility of that growth, and then how long can we see this growth kind of continuing. Each markets will behave differently. We may see some markets undergoing some pain, because at the current point in time what we are saying is not necessarily about markets, but geopolitics also is playing a significantly bigger role. So I really believe what we would see is some markets doing in a particular manner, other markets actually may behave very differently. India actually stands at a point where I really believe growth rates can continue for a significantly longer period of time. And if you look at volatility of India versus other parts of the world, that is dramatically different. In the past, in case of any volatility, we would have seen our currency actually going tailspin. This time actually has been different, right? So what India presents today is combination of growth and lower volatility. This lower volatility actually feeds into lower, or rather relatively lesser volatility in currency, and also relatively lesser volatility, or I would say focus on cost of capital, right? So if your volatility is low, cost of capital actually may remain subdued. And add to that, if you were to think about cost of capital also going down globally, markets actually may continue to remain buoyant, right? So what we need actually to focus on is, are our earnings growth on track? Quarter after quarter, while quarter may be a shorter time frame, we need to look at relatively longer time frame. In the short term, things may be volatile for reasons, but if those are on track, if we can see sustainability, then I would actually not be worried in markets.
Okay, and I'll come to the earnings in just a moment, but just tactically, just to make viewers understand why I was asking that question that I did, around budget and maybe post that, a lot of fund managers, mutual funds, and maybe even certain PMSs were sitting on large dollops of cash. Our analysis suggested that the mutual fund industry alone was sitting on about 1 or 1.2 lakh crores of cash. Now, my question, why I'm bringing this tactical perspective here, is that assuming that some of that cash has gotten deployed, but not all, would a rate easing cycle force some of the capital sitting on the sidelines to get deployed globally into global risk assets, locally into Indian equities as well? And can that spur the market higher? I'm asking you for a tactical view. I know you don't necessarily take that, but just think about it.
No, so see, this time rate easing actually could be a function of lower growth rates globally.
Sure.
Right? And if you look at US markets from a very short-term perspective as well, it remains very confused. So if you look at markets yesterday itself, when retail sales were pretty decent, and rate cut expectations were pushed forward, yet we saw markets actually going up, and going up decently, right? So markets actually from a rate perspective will matter, but not as much. It is about, are we seeing growth coming by, right? And that is where I would say India is different, right?
Okay.
And over period,
yeah,
I would think this cash deployment will happen in India. Many of the managers may be looking at more shorter term, because are we saying markets are cheap in India? Not necessarily. Markets may be valuing dollar for a dollar possibly, right? So to that extent, only when we deliver on to those expectations, we would kind of make decent returns.
Okay, fair call. In which case, let me ask you, since you mentioned that markets would be quote unquote slave to earnings, as the case may be, what did you make of the Q1 season? It was expected to be not so buoyant a quarter. I thought it kind of turned out to be that, with the sell side notes are saying that too. What did you make of the quarter and the commentary thereof? Do you believe that earnings are in fine fettle or not quite?
So it was a very interesting quarter actually.
Okay.
Because if you look at the quarter gone by, there were multiple factors which were one-off. Heat waves were pretty intense in the country. We had elections, right, which actually impacted businesses, right, from a short-term perspective. But even after that, if you were to dissect the quarter gone by and look at how sector after sector they have performed, possibly one can make a guess that commodity-related businesses actually were impacted significantly more than other part of the market. So when I say commodity, I mean global commodities. You can look at cement as well. You can look at oil and gas businesses as well. X of that, earnings growth actually have not been that low. It has still grown upwards of 15%. So to that extent, businesses which are relatively more structural, relatively where India is focused on, actually are in fine fettle. We may possibly say order inflow for capital goods infra businesses may not have been that great, but that was expected as well, because this was election season. Some amount of tendering actually gets delayed, right? So irrespective of this shorter term phenomena, do I expect year as a whole we kind of deliver 14-15% earnings growth? I would think that is the kind of run rate that's possible. In fact, not only for a year, possibly for 2 or 3 years is something that's a very high possibility.
Oh, okay. So therefore, this 20-21 times forward earnings multiple that we are assigning to markets, or the Nifty, let's not say markets, it's a very bottom up market currently. But if I use Nifty as a benchmark, is 20-21 times earnings 1 year forward a reasonable valuation to pay then?
At an aggregate level, possibly yes. But you know, when we look at indices, they hide many things.
Yeah, of
right?
course.
So to that extent, it will have a host of businesses, right? Businesses which fundamentally have lower P, businesses which fundamentally have significantly higher P. But difference versus past in case of India is this valuation improvement is backed by superior margins and superior capital efficiency as well, right? Our ROEs of the past and ROEs of today are different. Balance sheet of many of the stakeholders, whether you talk about banks, whether you talk about government, whether you talk about even consumers for that matter, corporates, actually is way better as compared to what it was in the past. Right? So to that extent, looking at valuation from the past lens actually may not be an appropriate thing.
Fair call. But yeah, because you ought to admit that the ROE profile of Indian companies and you know, a lot of people talk about 21 times being so expensive, viewers, but look at that. These numbers are not an anomaly. I mean, Indian markets now have gradually elevated themselves to those multiples. So it's not that we are trading at a 21 multiple, whereas in the past we used to trade at 15 times. So in some sense, I think it's a point to reckon with. Sumit, I would love to talk about some of the pockets, because you mentioned that an index hides more quite a bit as well, and therefore it's very idiosyncratic about specific pockets. The largest weightage in our portfolios, right, and for the market portfolio, which is BFSI and banks. What's the sense there? I mean, I hear equal and opposite views on private banks, for example, from fairly smart people. I'm trying to understand what is the bull and the bear case argument, and where is it that your bias stays?
So see, the way we look at it is, from a growth perspective, I'm not worried. Will our credit growth be closer to about 13 to 15% over a long period of time? That's a very high possibility, right? But it's not only about credit growth. It is also a function of how do we fund that kind of credit growth, right? Deposit is a challenge. Regulatory interventions are relatively higher. That has impact on cost of doing business as well, right? It has implication on the inherent growth that bank can deliver with the kind of ROE that they have, right? I believe many of those steps may be right steps from the regulator perspective, but it does have implication on what kind of ROE can bank deliver, right? So we, in general, have a relatively lower weight in banks as compared to, in fact, significantly lower weight in banks as compared to what it is for the markets.
Okay. So what, within financials, are you constructive anywhere? Lending, non-lending financials?
I believe NBFCs are relatively better placed. Even many of these non-lending businesses, right, whether it is market infrastructure linked businesses or other lending, non-lending opportunities, even for example, savings opportunity is a large opportunity in the country. Right?
By savings, you mean wealth or AMCs?
That is right.
Okay. Okay.
So, these are businesses which are significantly smaller as compared to the opportunity that presents to all of us, right? Over next 5 years, 10 years. If I ignore the shorter term, possibly many of these businesses will be significantly larger, right? So we actually are relatively more focused there.
Okay. I'd just love to probe this a little bit more. On capital markets, and yes. I'm choosing that one, and then I'll probably even try insurance a little bit. But first, capital markets. AMCs, some regulatory actions done in the past brought down the ability to earn the margins that they used to, if you will, now has stabilized. AUM is growing, the opportunity size is large. Is that a good pocket? Part two of my question is wealth. Non-AMCs necessarily, not just asset managers, but doing other kinds of market functions as well. There are, various opportunities out there. And then I heard you use the term market infrastructure. There are 3 or 4 players now there too.
That is right.
What within this bucket?
No, so if you look at depository parties, DPs, or if you look at registrars, right? So we have quite a large opportunity in that area. In fact, it's not only players like CAMS, KFINs of the world, but we have exchanges as well, right? Wherein, if you look at commodity exchange today, volumes are significantly lesser. Over period, they will be significantly larger, right? So it's not only about AMCs or wealth, but the basket is significantly larger in non-lending space as well.
Non-lending space. Okay. Just a word on insurance. I mean, the sector, has always shown this argument of India being an under-penetrated market. But I was doing the math since listing for some of the private insurers or even for LIC, the stock price return and maybe even the earnings growth has not been commensurate to the promise at least that it held, right? Correct. It's been for lack of a better word, a fairly sluggish return that these guys have given relative to some of the others, financial or even the non-financial buckets. Now, I as an investor, I'm not compelled to buy into an insurance name. I don't need to have it in the portfolio. What is your view here? Are you constructive insurance? If so, why? If you're not constructive insurance, why not?
So I think opportunity clearly is large, whether we talk about life insurance or non-life, right? If you look at non-life insurance, general insurance businesses as well, over last 15 years, industry itself has compounded at between 13 to 15%. Right? If one were to take into account all the general insurances that are there, some were not there in the past. Crop insurance has come in later, right? So that has actually accelerated the overall growth for the industry. Having said that, those businesses which actually can deliver a decent ROEV, or for that matter ROE, actually they will be value creators, right? So that is something we'll have to keep monitoring.
Okay. Okay, fair call. Sumit, stay on. We need to slip into a break. On the other side of the break, viewers, we'll talk about consumption in slight more detail, because that's the other interesting piece in the run-up to the festive season, and the fact that that space has gone through its own set of challenges in the last 12 months, particularly the lower end of the K curve. So we'll talk about that. We'll also try and talk a little bit about industrials. The results have been solid. The management commentary is bullish, but the valuations too are fairly steep. So try and talk about both of those very wide buckets with Sumit Jain. Stay tuned. Back with Talking Point in conversation with Sumit Jain of ASK Investment Managers, and we were talking about financials in the first segment and the markets at large. Now, talk about consumption. That's the big thing. Now, Sumit, a lot of varying views. We were at the MK conference for the last 3 days when the conference was on. A clear-cut winner was the revival of the rural consumption. Yeah. The commentary, maybe even in terms of evidence from the companies and their numbers. How do you think about this piece? I'm going to break up consumption into a few. Sure. Start off with the rural focused themes. And is there a change in sentiment and performance that you believe in, that you may have seen in results or in your conversations?
So, see, let's go to the past first. For last few years, that space has actually been impacted. Multiple factors have led to the impact on this space. Rainfall has been erratic. If you look at inflation, that has also had a very large bearing on their income levels. Right? What I believe from now on is, if we look at government stance as well, focus on job creation, focus on skill development actually has increased pretty dramatically. We may possibly start to see revenue expenditure of the government also kind of starting to inch up a bit versus what it was in the past. Last few years, revenue expenditure actually has been very subdued. So I really believe we may be possibly at a point where rural actually starts to bottom out. If you look at numbers as well of many of the corporates, the volume growth of even FMCG businesses actually has stabilized at lows. Over period will start to gain in terms of volumes, right? Will they be better than what they were in the past last 2-3 years? They should be better. Will they be significantly higher? Because many of these staple businesses from the penetration perspective are pretty decently penetrated. Can we expect them to grow at a significantly faster pace? Not really. But will they normalize? I really believe we will actually see normalization in many of these staple businesses. In fact, not only it's about staples, but I really believe many of the rural businesses with respect to agriculture, they actually will start to see improvement.
So on staples, just stabilization of the business, does it revert them back to the erstwhile higher multiples? They anyways traded high multiples.
They trade at similar multiple as compared to, close to similar multiple as compared.
So
but the difference versus the past is, in the past, their margins were on an improving trend.
Right.
Today, their margins are closer to what they kind of, I mean, they are not very different from the peak, right? And they will have to invest into advertisements as well. So to that extent, will we see profit growth way higher than revenue growth? Not necessarily.
So then, therefore, you will not, I'm presuming you will not have a large bet on them, if you will.
On the consumption side, what I would think is the place to be in would be discretionary. Right?
Okay.
If one were to ignore, I mean, let's move on from pure rural to the entire consumption basket, right? So, you know, if you think about IT spend as well, or rather IT hiring as well, we have seen actually IT hiring going down for last 5-6 quarters. Now it has been, this quarter has been a mixed trend. Some companies have hired, some companies still continue to remain at a number which is slightly lower, but that rate of decline actually has come down pretty meaningfully. So I really believe it's not only going to be about rural, but also about urban. Both parts actually should start to do well. What does this mean? Some of the discretionary kind of businesses, small ticket discretionary, could be consumer durables as well. Their improvement is going to be pretty sharp. That is the area I think is what one should focus on.
Okay, so could you elaborate, because it's a very wide bucket. You've given us a very succinctly, but still, how do you think about this, and therefore what pockets come to mind?
See, I think discretionary is a very, very interesting area. Consumer durable is just one. Then building products would be another. You would see many of those retail-oriented businesses, right? Smaller ticket, right? Which actually are used in household consumption. Those actually also will start to do much better. And many of these businesses have actually created niche for themselves.
Okay.
They have created distribution network. Over last few years, they have focused on the distribution network. And when we start to see normalization, their rate of growth actually accelerates.
Oh, okay. So, and within this very wide bucket, is there a first amongst equals? Are you more constructive on some specific buckets within this wide consumption? It could be building materials, it could be something else, it could be air cooling solutions, what have you?
We already started to see improvement on the consumer durable side. Everybody knows that air conditioner sales have been pretty solid, obviously. Climatic conditions have helped. But it's not only about air conditioners. If we look at refrigerator sales as well, if we look at washing machine sales as well, they used to be pretty low. Last quarter has actually been some improvement, right? So we are already seeing some improvement on that part of the market.
Okay, fair call. So you do expect that that improvement might continue, and therefore that's a discretionary consumption bucket that you might want to bet on.
That is right.
It's a very small the other part is very small, which is the upper end of the K curve, Sumit, which is the premium luxury spend market. Maybe 3 or 4 players present. They've had a really good run until now. Can it kind of moderate, or do you believe that continues?
I see no reason for that not to continue. In fact, what I see is significant change in consumption trends as well.
Okay.
So earlier it was largely about one can say product consumptions. Today services are also turning out to be a decent part of their consumption expenditure, right? So if one thinks about tourism as well, right? It can be part of the K-shaped recovery as well, right? The way you see numbers of many of these hotel industries, right? While Q1 may not have been that great, but clearly the commentary is different as compared to what their numbers were. So when we look at tourism, it's the entire ecosystem. Your hospitality businesses does well, your travel tourism does well, your travel agencies does well, right? So it is the entire ecosystem which actually starts to see improvement. So it's I would say multiple pieces, as you rightly said. Some on the product side, some on the experience side.
Okay, and therefore that brings me to my next question. I'm really keen to know, how do you think about aviation as a bucket? It's a small bucket. Let's say 4 or 5 listed players out there from airlines and airport operators milake, right? It's a sector that traditionally has never made money. But we've seen in the last 4 or 5 years, one airline come out and show that it can make money year after year after year. Okay. Airport operators seem to be doing okay as well, and the space is still evolving. Is that a long-term play, or is it difficult to take a call?
See, airports clearly will make money over a long period, right? But do we have enough listed players on the airport side? Pretty few. Even on the airline side, we just have very few listed players, right? Having said that, we will see more number of airports getting listed over period. Not sure of will we see more number of airlines getting listed or not, right? Having said, see, on the airlines, clearly world is short of aircrafts.
Right.
The ability of both the large aircraft manufacturer to kind of deliver aircrafts on time is challenged. So those players which have solid balance sheet will stand a better chance to actually increase their fleet sizes.
Right.
They stand a better chance to supply. Right? Demand should continue till the time prices don't go out of whack. Right. So will there be some level of elasticity? There will be, right? And we'll have to see where this equilibrium lies. But will we see airline traffic increasing at a rapid pace? We'll certainly see that. And will that be catered by few players? It will be catered by few players. Right? So will profit pool keep going up? If one were to ignore the volatility of external varieties that one can see. For example, crude plays an important role for these companies, right? So if crude is under check, currency is under check, we should see a decent profit compounding from these businesses.
A large profit pool, very few people can take advantage of. So key point to note. Just rounding off that conversation, and I'm presuming that you're constructive on hotels and some of the others as well selectively. I have one final question, Sumit, and which is now moving tracks and sectors, because you mentioned about IT services hiring, etc., and stuff like that. Because we are looking at a cut cycle, so on and so forth. What about external facing sectors, be it IT services, be it metals, etc.? Is there a tactical play, because some of them have been stagnant or been beaten down in the recent past?
Can there be tactical play? Possibly, yes. But we don't want to get into tactical plays per se. Simply because many of these businesses possibly may see relatively lower growth, while their growth rates may accelerate from the past of very low single digit kind of number to possibly high single digit. That is what one may possibly look at. Over long period, can we anticipate many of these businesses to grow at a relatively faster pace? I have my own doubts. Does India offer better opportunity as compared to many of these external global plays? Certainly, yes. There are many Indian, I would say domestic oriented businesses which actually over next 5 years, 7 years, 10 years will grow at a rate much faster than what we are talking about, right?
On the technology side, you're saying?
Not necessarily on technology side, but possibly on domestic consumption or on the industrial side, right? So to that extent, I would think there are a lot better opportunities as compared to pure software services that are there. Within software services, what we would actually be more focused on is into those businesses which actually are very focused on few areas, have strength. Technology investment there are increasing at a very rapid pace. it could be R&D investments there or ER&D investments there, which are increasing at a rapid pace. And consequently, they may be beneficiary of the large trend that the world is witnessing.
Okay, so maybe ER&D or maybe product companies which could be doing this. Great. Okay. Sumit, so good talking to you. Thank you so much for taking the time out and being with us. Really appreciate it.
Thank you, Neeraj. Thanks for having me here.
The pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.